Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Market5. I'm your co-host, Joel L. Connon, along with Brianna Velasquez, and we have Chris Martenson on the line. He's an economic researcher and futurist. How you doing this morning, Chris?
Joel, Brianna, I'm doing very well. Thank you much.
Yeah, thanks for coming on again. We always appreciate your perspective on the market. So we've had a 100-point plus rally off the lows from last Friday on a bad jobs number. Does that make any sense to you?
Well, it doesn't make sense from a fundamental standpoint, but of course the markets are no longer really trading on fundamentals. They're trading on what they think the Fed is going to do next. Obviously, I think this is an overdone rally at this point in time because what happened? Well, nothing. And even if the Fed did raise to a quarter point from its current 13 basis points, that's an eighth of a percent hike is what it would have been. That's meaningless, too. It's not going to fundamentally change the liquidity landscape. So I think the markets are really trading more on what they think the Fed is going to do, and I think the markets are correct in understanding that the Fed is going to do more. But I disagree with the markets because I don't think the Fed's going to be able to do more until it has some sort of a reason to do more, which would be some sort of a new round of market volatility or downdraft.
And so there's also things that are going on that affect the overall market. Different macro things is going on. Number one, China. Give us your take on the Chinese market.
Well, they just came back from a holiday, and all eyes were on the Chinese stock market as some sort of indicator that opened up weak. And the story coming out of China is one of continued weakness. Of course, no surprise, right? They had 50% of their GDP was related to building ghost cities and related infrastructure projects like that. That obviously has an ending point. You can't keep building forever. That's slowing down. We're seeing in all the related commodities markets, there's been a little bit of a snapback in some of the commodities, in particular in oil and copper. But when we look at the import-export data, there's nothing there to confirm that China has in any way done anything but continued to slow down.
Yeah, and you can see it. I mean, in the charts here, it's gotten a little bounced off the lows here, but still weak manufacturing and production data coming out of that country. Just related to commodities here, I'd like to get your take on the oil market. Over a month long in consolidation was resolved to the upside, and then they didn't like the inventory build data here. Is this just a dead cat rally in an overall bearish market in crude oil?
Well, a number of very interesting things are happening. Anybody who's got a couple of year time horizon on this knows that oil has to go higher at some point because we are below the marginal cost of production. We've had a lot of big wipeouts, about $1 trillion to $1.5 trillion, depending on who's counting, of investment has been stalled, forestalled, or just entirely canceled in terms of future oil projects. We saw Shell retreat completely from the Arctic. We're seeing major projects get pulled everywhere. So against that backdrop, we know that American oil production is headed down at this point in time. It will only continue to go down as long as oil is below $75, maybe $80 a barrel. So in the future, we have a supply issue, but it's a few years out. Traders are looking at this quarter, this week, this minute. There, we still see an oversupply in the world oil markets at this time. Russia producing near record output, Saudi Arabia near record output, United States still pumping like crazy. So near term, we have a little bit of a supply issue, too much of it. Long term, obviously we're going to have a supply shortfall if the economy improves.
Yeah, because just a little mixed here because you said it has to go to 75, 80 over the course of time. I mean, in order, because that's where the cost of production is, but I mean, boy, that's quite a bit higher here. That's 15, 20% higher in here. I mean, with the economy slowing down around the world and, us maybe perhaps going into a recession, China not looking good, Europe falling apart, where's the demand going to come from?
Well, that's the big question. So obviously the larger dynamic here is that we're at the tail end of one of the largest credit cycles the world has ever seen. It's been global in participation. We're already seeing the early stages of that credit cycle unwinding in the emerging market economies. We're clearly in the contractionary phase of that. Those are very painful moments that can drag economies well below their natural rate of advance. So we're probably looking at a very long recessionary period, unless new loans, new credit lending, and new economic activity can be stimulated. But you're right, Joel. When you look around the world, you can't see anything but pretty much a mess in all of the major economies out there. And this, to me, is the greatest failing of quantitative easing, of the Fed policy, ECB, Bank of Japan, is that they did this thing to print money, double fingers crossed, hoping that this demand growth would come back. It didn't come back. What they did was they inflated asset prices. So that's why we have a market-driven Fed right now. They've created a Franken-market. They're scared of it. They don't want it to go down. They don't know how to get it to go up. They look a little increasingly and a little ineffective.
Yeah, at this point they do. Other macro factors, affecting our economy, also the oil market, the situation in the Middle East. Have you been following that?
Well, I have, and of course it's got a 1,000-year history of being a little bit of a mess, but it's more recently a gigantic mess. The United States is Middle East plus North Africa. When you look at the United States' involvement in all the countries, we've kind of left a little trail of wreckage over there, and so now it looks like it's shaping up into a larger Sunni Shia sort of a conflict. Iran on one side of that story, Saudi Arabia on the other, and China's now involved over there. Russia's involved. We're involved, and of course we all have to be, because when you look at where the last remaining deposits of cheap and available and most importantly exportable oil remain, it's all in the Middle East, particularly in Iran, Iraq, and Saudi Arabia. So that's the Golden Triangle. A lot of people are going to be interested in that story, all the major players. Nobody can be uninvolved in the Middle East for the next couple decades. So we're seeing a lot of jockeying around that. And of course, when it comes to military conflicts, anything could happen. So we're seeing NATO begin to step in, saying that they want to have troops on the ground over there, maybe putting them into Turkey, but putting them right next to where we know now there's a battalion of Russians in Saudi Arabia heading there. So ground troops are about to get involved. Listen, in the fog of war, anything can happen, and it's getting hotter. So that's something we're going to have to keep a very close eye on.
All right, and some bad news out of the European banks this morning. Deutsche Bank considering, cutting their dividend. Looks like Credit Suisse needs to, to raise some more money. I mean, once again, not a pocket of strength over in Europe.
Well, the Deutsche Bank story is interesting. I think some fire got exposed today, but I think there's more smoke hinting there's even more fire under that. We've been watching warning signs coming out of Deutsche Bank for months now, and including the triple resignation / firing of some of their C-level people a few months back. Clearly something happened over there. Obviously, we don't know what, but there's concern that there was a derivatives accident. For now, they're trying to say that it was just contained to one portion of their business. They're going to have to take a charge. But my guess is they're probably wrapped up with the Volkswagen scandal somehow, that there's a big exposure there. The Deutsche Bank holds a huge amount of derivative positions. If those went upside down on them, something could happen. So I think there's more to the Deutsche Bank story to come out. So far, some has been revealed. I don't think we're done with that part of the story yet. And obviously, that's a big, big deal when you see that financial weakness in a major player like that. You have to remember 2007 and 2008. That's where that story began as well. So my advice to people is keep your eyes on the financial sector, watch the individual bank stocks, and watch other things, the mutual funds, the insurance companies, other companies that are heavily exposed on the financial side, because if that's contagious at all, we'll be able to see it in the share prices and the credit default swaps on those companies.
Right, and the U.S. financials got a little bit of bump earlier in the month because of anticipation of the higher rates. That didn't come to fruition. These stocks have been hit pretty hard. Wells Fargo, J.P. Morgan, well off their all-time highs. What's your take? Do you have any particular U.S. banks you think that may be safe havens?
Well, the safe havens, for me at this stage, I go to the OCC, the Office of Comptroller of the Currency. I go to their report. They have a quarterly derivative position on banks. I like to look at that. Anybody who's in the top 25 derivative position bank, I try to steer clear from. I'm really leery of that whole area. I've analyzed it as much as I can. I still don't understand who's holding what and what the real exposures are. If you try and read J.P. Morgan's quarterly statement or annual report, it's 200 or 300 pages, and there's important stuff contained in footnotes, and it's cryptic and vague. So when I can't understand something, my tendency is better safe than sorry. I am personally avoiding all those big issues if they can't explain to me in layman's language really where their exposures are and what the risk is, I'm not interested in holding them. So I'm sticking to, I like regional banks. I happen to like safer financial issues, those who are not holding big, opaque derivative positions. There's still some good companies out there, but the big ones, I'm telling you, there's something there I don't like.
Who was on that list? You said of the top 25 banks holding big. Is it the who's who of your big banks? J.P. Morgan's Fiberton in the chat says about 6 months ago he read that J.P. Morgan has 55 trillion. Is it just all the big banks that you would think of? Bank of America, Goldman Sachs, Morgan Stanley. Now Wells Fargo, I don't know. I don't think they're in that list, are they?
Well, they are on that list, heading that list, I think Citibank finally took over J.P. Morgan for the top position a couple of reports ago. I think J.P. retook the top position, but it's the who's list, and it's very interesting to see who's been. It's a great report. It's very understandable, and one of the more interesting things is to look under there and to see where they've been increasing and decreasing their derivative exposures. Citibank has taken on extraordinary commodity exposure, and it really spiked just in the last quarter. And that's very interesting, of course, to me as I watch what is probably the end run of our day unfolding right now, which is the Glencore dissolving that's happening right before our eyes. There are huge exposure positions, counterparty positions just becoming revealed at this point. Obviously something a little ugly going on in the whole commodity side, and seeing that Citibank vastly increased its exposure on specifically the commodities, even more specifically on metals. It's an interesting thing you can find in that OCC report, and it wasn't just a little bit. Citibank increased its exposure by thousands of percentage points. It was a very, very large thing. I don't understand it yet, really what's going on there, but it's just a big fat bar in the chart on one of the graphs that they present.
All right, so you don't think this Glencore story is over yet? I mean, I thought, it had got the beats and then kind of came back out with, we have plenty of money and liquidity and stuff. You think we've heard more, haven't heard the rest of this Glencore story?
There's a great story in Glencore. Start tracking it. Go back to 2014 and start watching reading what the CEO has been saying. The guy's uber bullish. In fact, right up until literally a month before they hit the skids, the CEO and the CFO were both saying, we're in great position. We really like how the future looks. We've got plenty of cash. Everything's fine. They're saying that, and then just a month later, everything fell apart for them. So either they were unaware of how tenuous their position was, which is not comforting, and when your CEO and CFO are not aware of that, or they weren't being completely forthright. Either way, I'm discounting what they're saying today just a little bit.
Anything you do, like either individual stocks or individual issues here that may be a little bit of a safe haven here to have some rocky waters ahead?
Well, I'll tell you, I've been building a cash position for a while. I like cash as a position at this point in time, U.S. dollars in particular. I think there are better prices for all kinds of things. I am getting very interested in oil. I've been sniffing around that for a while. I'm not sure if it might have one more run down. I'm going to watch, not try and catch an exact bottom or a falling knife here, but I know that over the long term, oil's going to go up. There's huge consolidation happening right now, just beginning in the shale patch. We're going to see a lot of turnover of some key assets. There's going to be a bunch of companies that are just plain out of business. Other companies are going to be able to pick up their assets, hopefully for pennies on the dollar, and then we'll consolidate, and we'll see, I think, a more mature, a little bit not as explosive, slower growing, but very profitable shale business. Once we get back up to 75, 80, we'll get there again. So I am really pretty bullish on that industry going forward, but not quite yet. I'm still watching.
And what do you think about the recent run in some of the dogs, Alcoa, U.S. Steel, Caterpillar, Deere here? Is it just the market just trying to find some value in the garbage heap, or is there really going to be a turnaround in these stocks?
Well, I don't know what when you look at it on a fundamental standpoint, we've been seeing some pretty big earnings disappointments in every single one of those issues you just mentioned, plus some other big ones. Monsanto just came out with a real dog of an earnings report yesterday, and the market digested that, and the stock actually went up slightly on the day. So we're not really seeing a fundamental approach yet, where I would say that you look at earnings now, earnings going forward, they clearly point to we should have lower prices at this point for those equities. if you are on a fundamental side, but that's not what's driving the market right now. So if I want to understand really why a market goes up or down, it's all about the correlation pair trades. It's all about what's happening globally. It really doesn't have as much to do with the individual issues themselves anymore on a fundamental basis. So many times if I'm asked, why did the U.S. stock market go up, I say, well, let's look at the USD yen cross. Oh, look, there was a big shift in that, and it exactly mirrors and was part and parcel of the correlation pair driving the U.S. markets. That's what you get in a world that's awash in liquidity. You get a lot of speculation, the big money sloshing all over the place. Sometimes you can't make sense of that on a fundamental basis. You have to understand it on liquidity flows. So I look at the markets and I say there's still plenty of liquidity sloshing around, but it's increasingly trying to find a safe place to land. That's becoming a harder and harder job. You can feel the nervousness. A lot of money managers are talking about that now, just how hard it is to do their jobs in a fiduciarily responsible manner. Tough job.
Yeah, it is. It just we only got about a minute here before we let you go, Chris. You sound a little bit skeptical about this quarter's earnings, and I don't know if they, we can blame the dollar or something like that. But give us your take on the upcoming earnings season.
Well, from a longer perspective, we're about 6 years into this so-called recovery. It wasn't a magnificent recovery for a lot of people and companies, but it was a great earnings recovery. Earnings hit 11% of GDP. It was an astonishing number, never before seen. I believe in reversion to the mean. I think they had to go back to 6% of GDP, maybe overshoot at some point. That's just where I think we're going. So when we look at top line, that's what I care about most because there's been a lot of shenanigans with earnings per share, with the stock buybacks and non-GAAP accounting, all that. So when we look at top line, we have a year-over-year erosion in revenue, strong dollar not helping that story. But when you see that rollover in year-over-year revenues, that's a warning sign. That's usually been a good early indicator that you're on the rollover process. Best to watch that. Pull up a monthly chart of any index you want. I think you're going to get a story there that tells you where we are.
Chris Martenson, economic researcher and futurist, sharing his opinions on the overall market, commodities, Middle East, China, the Fed. Chris, you covered it all. Thanks a lot for coming on. We'll speak to you again soon.
Joel, Brianna, my pleasure.